Welcome to a special episode of ISG's Imagine Your Future podcast. I'm your host, Karen Collyer, and today I'm joined by Owen Wheatley, our lead partner for banking and financial services. Hi, Owen. Welcome to the pod.
Thanks, Karen. Delighted to be here, of course.
So I wanted to talk to you today to get your take on what's currently happening in the banking and financial services sector. There has been a lot of turmoil. And last week, we saw the failure of Silicon Valley Bank, or SVB, as everyone's calling it. And I'm curious, why did it happen?
Yeah, I mean, it's a good week to have me on. It's headline news everywhere around the world, of course, and for good reason, because everybody remembers what happened in 2008-9 at Lehman Brothers and everything that happened ever since, kind of a lost decade of growth for many industries and families. So understandably, it's topical. Yeah, happy to give you my view on why it failed in the first instance. I mean, I think when people throw around figures like it was the 16th biggest bank in the US, and it feels like, wow, that's a big bank to go down. And it was a big bank to go down by assets. But it's a very specialist bank. It had a unique business model with heavy reliance on venture capital funded tech startups in particular, and some scale ups as well. And it also catered for kind of wealthy private individuals, typically kind of Silicon Valley based individuals. So it's a very different kind of bank from a regular retail bank or a commercial bank that we see elsewhere. That's the first thing to say. The reason that's important is because I'm guessing that one of the things that we'll be talking about, could this be systemic? Is this a repeat of 2008-9 and so on? So we need to understand the specifics of SVB in order to be able to answer that question later. One of the things that we saw from a business model perspective, I mentioned that their deposits are largely those kind of tech-related startups, often VC funded. What they did between 2019 and 2021, as these sort of deposits racked up, of course, deposits are liabilities for a bank, they needed to build up their assets. And the way that they did that was they bought a relatively, well, in industry terms, a relatively high percentage of treasury bonds at what were at the time relatively low interest rates. We all remember the low interest rate environment that we've kind of enjoyed, I guess, for the last decade or so. They were up to 30 years in length, and that's a pretty standard thing to do for most banks. It's not an issue if you keep those bonds for the long term. They're kind of safe haven. The problem in this case was that we've seen over the last 12, 18 months, VC funding for tech startups more generally has started to dry up. We've seen a lot of losses of tech startups and scale-ups, a lot of consolidation in the industry, a lot of a shakeout. These demanding plans to profit and a refusal to just keep investing in ideas without concrete roadmaps to margin. So as that funding dried up, if you can imagine, if you're one of those tech startups, then what you need to do is you need to tap into your existing funds. In other words, the deposits that you had at Silicon Valley Bank. And so they started to see some significant deposit withdrawals at the bank as the startups needed to draw on those savings to keep themselves going. Now, again, that would be okay from a liquidity point of view if you were able to fund that. The issue for SVB was that in order to fund those deposit withdrawals, they had to sell off some of those longer-term bonds that we just talked about. And because the value of those bonds had actually gone down since they bought them, remember they were expecting to keep them for up to 30 years, this crystallized quite a big loss, almost a $2 billion loss for the bank. Now, what that did, and think of this as almost like a domino effect, is you've got withdrawals of deposits, then you show the market that you've just made an almost $2 billion loss on treasury bonds. It kind of spooks the markets, and it also spooks individual depositors. And so you get a snowball effect with more depositors withdrawing their funds from the bank. This is, I guess, what you would call a classic run on the bank. And it got to the point where the bank became unsustainable. So it was a combination of factors for why it failed, but in the main, it was largely due to their reliance on those kind of tech-heavy depositors that ended up having to withdraw their money and then choosing to withdraw their money in two different phases. Does that make sense?
Yeah, totally. So tech-heavy depositors, and probably not the most flexible of instruments when they were trying to get the money back out. I heard on the news earlier this week that another U.S. bank, another institution actually failed, Signature Bank. And I think that I also heard that Credit Suisse in Europe is having some issues as well. Do you think other North American and European banks will fail?
The short answer is probably. The question is, will they be systemic banks? Will they cause systemic damage? we just said that SVB, their business model was unlike other banks, and that's absolutely true. So we shouldn't necessarily extrapolate too much. And certainly what we've seen in the stock markets is that kind of broad-based initial panic. Will this trigger another financial crisis? And you can imagine a sell-off of banking stocks around the world, almost regardless of what their individual business models were. But then gradually, as the dust settles on the SVB situation and Signature, although Signature's own specific situation was crypto-based, and we've seen a lot of crypto institution failures over the last few years, largely on the exchange side. Again, a very sort of specific and different situation, nonetheless serious for those associated with Signature, of course. But, the risk of genuine contagion is much smaller than it was back in 2008-9, simply because what we've seen is due to the specifics of a business model that is not widespread in the industry. Having said that, we are seeing other banks suffering, and First Republic Bank is the next one, kind of the next cab off the rank, if you like, in the US. And one of the reasons for that is because although its business model is different from SVB, it isn't heavy in terms of VC-funded tech startups. It is heavier than average as it relates to the proportion of deposits which are above the $250,000 insurance limit. I think 2/3 of their deposits are above that limit, against around about 50%, which you'd see as average. SVB, by the way, was 93%. So you can see the exposure in the SVB case. One of the reasons for this is that FRB, First Republic Bank, their model also relies on high net worth individuals and private investors who typically have more by way of deposits than regular investors and savers. So this again makes them more susceptible to deposit withdrawal in times of the market volatility, I guess you'd say. So that's why they were targeted from a sell-off perspective. What we've seen this week, of course, Karen, you'll have seen that a whole board of Wall Street giants, some of the big banks, JP Morgan, Citi and others, have come together and provided a capital injection into FRB to reassure the markets that the bank is good, we're investing in this bank, there's no issue here, nothing to see, please move on kind of thing, because it's in everyone's interest, especially the tier one banks, that this kind of period of uncertainty settles down. So we will see others come under the spotlight. I think it's quite right, actually. And in the end, we might look at this as a healthy phase, because it's quite right that investors and analysts look at the individual business models of banks and figure out, is this sustainable in the event that X, Y, or Z happens? I think one thing that I will say at this point, I'll come on to Credit Suisse in a minute because that's different again. But one thing this has done, Karen, is shine a light on the regulators and the degree of regulation under which SVB was operating and FRB and all of these other ones. We all heard of the Dodd-Frank legislation, which was around capital requirements and liquidity and stress testing following the financial crash in 2008-09. But back in 2018, that regulation was rolled back to some extent for banks of $250 billion of assets or less. And certainly SVB, although it was the 16th biggest, it was still under that cap. So in fact, today, I just checked this morning to make sure I have my numbers right, there are only 14 US banks with assets of $250 billion or more. So for every other bank, they don't face the same level of scrutiny and regulation as the very biggest banks. And in 2019, there was a famous quote from the Fed that's being put around media outlets right now that said, large regional banks are not systemic and don't need such close regulatory and supervisory scrutiny. So if you can think about the specifics of SVB and FRB and some of these others, they're also not subject to the same rules on capital liquidity, balance sheet robustness and scrutiny as the likes of Bank of America, Wells Fargo and others. Did the regulators take them off the ball? I mean, this is one that's going to run and run, I think. So I think just coming to the second part of your question on credit, this is an interesting situation, different again, because CS is a bank that has, for the last probably 5 years, has been battered and rocked by a series of scandals and poor results. So a lot of this is of their own making. We've seen cases of fraud, we've seen cases of bullying, we've seen cases of misstated results, and we've seen their stock plummeting anyway, despite the contagion we've seen this week. It's already been plummeting over the last 5 years. We've had multiple changes in leadership at the bank. They've lurched from one strategy to the next. They've never really been able to repair the reputational damage. And the big anchor for them, which is dragging them down, is their investment bank, which has been loss-making for several years. So from a financial health point of view, they weren't in a great place anyway. And naturally, if you're an investor and the sell-off was taking hold, Credit Suisse was always going to be one of those banks that was going to be hit. They do have a stated plan in their case to divest the investment bank and focus more on private banking, high net worth individuals, wealth management services, with a primary focus in their domestic market, which is a much higher margin business, and they're much better at it, frankly. But the most interesting thing, perhaps, to me, Karen, at the moment with Credit Suisse is this talk of a takeover, perhaps by their great rivals, UBS, who have ridden the last 5 years much better than Credit Suisse. That really would be something to behold.
I'm based in Canada. You're based in the UK, even though I know you work a lot in the US. I think we benefit from a higher level of regulation on our banks. I know in Canada, at least, it's mostly because we really only have 5 major banks with a couple of smaller institutions. So it's easier to do. We don't have the regional banking issues that the US does. I'm assuming that it might be similar in the UK. But yeah, it's interesting. You did say something earlier that I wanted to come back to, which is a lot of people right now in the media are making comparisons between what was happening in 2008, 2009 with Lehman Brothers and what we're currently experiencing. Talk to me a little bit about that. What do you think?
Yeah, and it's natural that people make those comparisons because we all remember those images of bankers leaving the Lehman Brothers offices with their boxes. The collapse was kind of spectacular in the worst possible way and sudden, and the ripple effects were felt for a decade afterwards. The fact that at that point regulation was a lot lighter, and the fact that a large bank could go down and cause a systemic problem for the entire banking system. Liquidity dried up. If the banking system grinds to a halt, then of course that impacts all other industries as well. And the lack of investment that then follows, massive rounds of reductions in force, not just in the banking sector, but all those other industries that rely on the banking sector to grease the wheels. Unemployment, that means lower consumer spending, that means a recession. And that's exactly what we saw following 2008-9. And in fact, many banks, especially European banks, never recovered to the extent that we're still seeing flat revenue in a lot of cases for European banks and very low return on equity, and certainly single digit in Europe following 2008-9. They've never really got back to where they should be following that crash. So that really was the definition of a systemic issue with all of the associated economic impacts that it had. In this case, I do think it's different. I think it's different because the systemic banks, those that are deemed, that classic phrase, too big to fail, we are protected as consumers from the perspective of the heavier regulation on those very biggest banks. And I mentioned, you could argue perhaps we shouldn't have collectively reduced the regulatory focus on banks of $250 billion and below in the US, but nevertheless, even for those banks, there's much greater regulation now, much more significant and severe capital adequacy requirements, liquidity requirements, much greater scrutiny from regulators around the world than there was going back to, let's just say, 2007. So the overall framework is more robust. That's number one. The second thing is that, as I mentioned, SVB is a specific situation related to their business model. That's not to say other banks don't have susceptible business models, and it's not to say other banks can't and won't fail. I suspect some may need some bailout support. We talked about Credit Suisse. They've just taken $54 billion worth of funding commitments from the central bank in Switzerland. We might see a bit more of that, but I don't expect to see the banking system grinding to a halt. I don't expect to see liquidity grind to a halt, and therefore I think the implications on the rest of the economy and other industries that rely on the banking sector will be dampened down, much less severe and significant than we saw back in 2008-9.
Right. Well, as you said, it's an evolving situation. I think it's really interesting that the bailouts, I'm using that in air quotes, are coming from other banks versus governments for the most part in the US. And it'll be interesting to see if some more banks run into trouble, whether that changes or not. Because I know the too big to fail is a real thing, but it would also be a very unpopular move for a government to step in and provide funds.
Yeah, it's a great point. And in fact, we've seen this happen in a number of different ways already. I mentioned earlier the collective of banks that are stepping in to inject tens of billions of dollars into First Republic Bank as a sign of not just solidarity, but confidence, crucially, confidence in FRB, and as a proxy, confidence in the US banking sector. That was a very strong statement that did make a huge difference. There was a huge surge in FRB stocks as a result of that. It's slightly fallen back since, as you would have expected. I think there's still people trying to figure out where is this going to end up. You also, when you get into this situation of volatility, you also then have to factor in those that are looking to simply make money by the movements in the market in the short term. So we started to see some shorting of stocks on certain banks. That's just to be expected. That's the nature of the markets. But it's a very strong message from the likes of JP Morgan and Citi and others to say we stand together. I think they're doing it for a number of reasons. It's not totally altruistic. They are self-interested too. They don't want the system to gum up and grind up. They need liquidity in the system. That's absolutely true. But I do also believe, you mentioned there about this wouldn't look good. I think that's a huge factor too. One of the things that we've seen even before this last 7 days of turmoil is banks trying to do what they can to repair their reputations and, if you like, their brand image with consumers and the broader market. And I say that because there was a sense after 2008-9 when the big bailouts happened, that the taxpayers around the world were thinking there was a perception that these greedy bankers got bailed out by taxpayers, Main Street bailing out Wall Street, all of that kind of narrative. And that's never really gone well. And it's undermined trust in banks. It's one of the reasons why we've seen the digital currency spikes that we have, because the faith in the traditional system was very much undermined by that last crash. And so I do think that there's also an element here of trying to repair reputational damage from a decade ago, sort of saying, look, we're good guys, we stand with America, we stand with the banking system. It can take many forms. It can be direct investment, as it is in the case of First Republic Bank. It could be in the UK, for example, HSBC took over Silicon Valley Bank's UK operations, and they bought them for £1. Of course, they're taking on the liabilities as well. But they in that case, I think there's a reputational angle in that particular case, though HSBC itself has a pretty strong heritage and reputation for investment in tech startups and scale-ups. And I think they're basically saying, look, it's not that the business model was flawed necessarily with SVB, it's that they stretched themselves too far. And they think that they can make something from those consumers and what's left of the SVB business in the UK. So governments and central banks will be absolutely delighted to privately run banks stepping in this way, because it means that they don't have to as much.
Okay. So I definitely feel more knowledgeable after this conversation, and I think I'm a little less financially intimidated as a result of this. So thank you so much for taking the time out of your day to get us all up to speed. I really, really appreciate it, Owen. It was great.
You're very welcome. Thanks, Karen. Speak to you soon.
Okay. Well, everybody, that's a wrap on today's episode. So as always, if you liked today's content, you can download previous episodes at isg-1.com/podcast, or you can listen for us wherever you get your normal podcast feeds. Thanks again for spending time with us today, and we'll chat soon.